Hi everyone, welcome back to my YouTube channel. This is Raz. In this video, we'll discuss about how to compute the estate tax for an unmarried or single decedent. So if you're ready, let's start. So we have discussed already how to compute the gross estate as well as the deductions from the gross estate. And in this video, and for our future videos, we will discuss about how to compute the estate tax for unmarried decedent or single decedents. So our legal basis for the computation or for the imposition of estate tax is according to Section 84 of the National Internal Revenue Code of 1997 as amended by the Republic Act 10963. So it said that there shall be levied, assessed, collected, and paid upon the transfer of the net estate as determined in accordance with sections 85 and 86 of every decedent, whether resident or non-resident of the Philippines, a tax rate of 6% based on the value of such net estate. So before the train law, before the old tax code was amended, there was actually a graduated tax rates for the estate tax. So when you say graduated, meaning the tax rates rather increases when the tax bracket or the value of the estate also increases. But with the train law, with the R8 10963, every net taxable estate is just multiplied or taxed at 6%. Okay, so there is no graduated tax rate for this. Actually, the same goes with the donor's tax. So here's a sample illustration on how do we compute the estate tax for an unmarried decedent. So we have here Juan, a single and a citizen of the Philippines and a resident of Bohol, died on January 26, 2021, leaving the following properties. And we have here agricultural land in Bohol, and that was inherited from the father 2.5 years ago, when the fair market value of such property of that land was 10 million back then. But today, upon his death, the fair value is 12 million pesos. And also we have personal properties valued at 3.6 million. We also have family home, which is valued at 7 million, and claims against Pedro, the debtor, who is an insolvent person. So Pedro has a debt to Juan, and this debt remains unpaid by Pedro, who became insolvent at the time of his death of Juan. So we also have here proceeds of life insurance, the estate being the beneficiary. So as we know, in proceeds of life insurance are exempted from the estate tax, but there are conditions. Number one, the beneficiary should be third persons other than the decedent himself or his estate or his executor or administrator. And also, designation of such beneficiary shall be or should be irrevocable. But in this problem, it is said that the beneficiary is the estate of Juan. Therefore, this is not exempted from the tax. Okay, this is taxable. This is subject to estate tax because the beneficiary is the estate itself, and there is no and it's not given whether it is irrevocable or not. Okay, so actually, if one condition is not met, the proceeds will be entirely taxable. Okay, so we also have here deductions claimed by Juan, unpaid mortgage on real property inherited. So the mortgage assumed at the time, so remember the agricultural land inherited from the father of Juan 2.5 years ago, there was actually a mortgage assumed, as the problem said, which was 1 million that time. But today, the remaining balance today at the time of his death is now only 400,000. Therefore, there was already a payment by Juan amounting to 600,000 pesos. And we also have other obligations which was contracted within the last 2 years, which is 550,000, and accrued and paid taxes at the time of his death, which is 300,000 pesos. And we also have here losses incurred on his farm in Bohol on March 3, 2021. So Actually, these losses can be deducted from one's gross estate because the loss was incurred after his death, but prior to the settlement of the estate itself or the payment of the estate tax. So hence, this loss could be deducted from his gross estate. Okay, so we also have here finally a donation to charity to take effect on his death, a cash worth of 500,000 pesos. So now let's compute, or let's go to the solution of this problem. So we have here, our first step is of course to compute the gross estate. Okay, so we have here agricultural land in Bohol inherited from the father, and that was 2.5 years ago, when the fair market value at that time, 2.5 years ago, was 10 million. But today, the fair value is 12 million. Therefore, we would consider only the 12 million when computing the gross estate, because estate in general are valued at the time of the death. We also have personal properties, 3.6 million. We also have family home, that is 7 million, and claims against Pedro. So again, we need to add these claims against Pedro because on the part of Juan, this is a receivable. On the part of the decedent, Juan, he has the right to collect from Pedro this amount, 1 million, and that right has not extinguished yet, right? The right is still exercisable, okay? But then, we should also take note that since Pedro went insolvent upon death or after death of Juan, therefore, we can also deduct this claims as a deduction from the gross estate later on. Okay? So, we also have proceeds of life insurance. Again, this is not exempted because to be exempted from the estate tax, the proceeds should be designated to a third person like the wife, which is he is single, by the way, or his children, or brother, or relatives. But in this case, the beneficiary is the estate itself. Therefore, the first condition is not met, hence taxable. So our total gross estate is now 25 million pesos. Okay? After we have computed the gross estate, now let's go to step 2. Okay? In step 2, we will now compute the ordinary deductions, the losses, indebtedness, taxes, and transfer for public use. Remember, there are 5 items under ordinary deductions: the losses, indebtedness, taxes, or shortly called as the LIT, okay? And also the transfer for public use, and the last one is the vanishing deduction. So since there is a property which was subject to vanishing deduction, that was actually the agricultural land which was inherited 2.5 years ago. So we will first compute the first 4 ordinary deductions: losses, indebtedness, taxes, and transfer for public use, because later on in our step 3 we will compute the vanishing deduction. Okay, so our ordinary deductions, we have losses incurred on his farm in Bohol. Again, that is deductible because this is a legit deduction. Okay, unless of course the problem would say that this loss was deducted already on his income tax. And also the unpaid mortgage. Remember, the property inherited from the father was subjected to a mortgage, and Juan assumed the mortgage, which at that time that was 1 million pesos. Okay, that was the mortgage that Juan assumed. But today, at the time of his death, the remaining balance is only 400,000 pesos. So therefore, in our LIT, in our losses, indebtedness, and taxes portion, the ordinary deduction, we can only claim 400,000 as a deduction from the gross estate because that is the outstanding balance of the mortgage. And we also have other obligations contracted within the last 2 years, which is 500,050, and claims against Pedro, the insolvent person. Okay, so remember, I've told you a while ago that we added this in the gross estate, but later on, we can deduct this as a deduction from the gross estate of Juan, because in essence, though it is a receivable, but there is no sense of taxing this because there's nothing to collect from Pedro. Pedro is insolvent already. Though it is a receivable, the right still exists. The right is still exercisable upon death of Juan, but Pedro is now insolvent. Therefore, there is no sense of taxing this 1 million pesos, hence deductible. And also, we have accrued and unpaid taxes at the time of his death. Again, taxes can only be deducted from the gross estate of the decedent, provided that these taxes have been accrued already prior to his death and only paid after his death. So that is 300,000 pesos. And finally, we have donation to charity to take effect on his death, a cash worth of 500,000 pesos. Okay, so this is a transfer for public use. Okay, so our total deductions here is 3.1 million pesos. So this is the ordinary deductions before vanishing deduction. We will use this amount because remember, in our computation for vanishing deduction, we are going to use the lit and the transfer for public use. Okay, so that is 3.1 million pesos. So our step 3 now is to compute the vanishing deduction. So we will first determine the initial basis, which is the lower of the fair value of the property at the time of the gift or inheritance versus the fair value of the property upon death of the decedent. So we are going to compare which fair value is lower. So the fair value at the time of transfer was 10 million pesos, while the fair value at the time of death of Juan was 12 million pesos. Therefore, we are going to use the 10 million pesos, the lower amount. Then after we have determined the initial basis, we can now deduct the paid mortgage. Remember, there was a mortgage of 1 million, which is assumed by Juan, by the way, and at the time of his death, the remaining balance was 400,000 pesos. Therefore, we could say that during from the time that Juan received the property 2.5 years ago to the time of his death, Juan already paid 600,000 pesos. Therefore, we should deduct that 600,000 pesos from the initial basis to get the new initial basis, as what we have discussed in our previous video lecture. And after we have determined the initial basis, we can now proportionate the lit plus transfer for public use. So remember that we have already computed the lit plus transfer for public use. That was actually in our step 2. That was 3,100,000. So it will become 9,400,000 divided by 25 million. So the new initial basis of 9.4 million divided by the total gross estate of 25 million times the lit plus the transfer for public use. So the deductible portion here is 1,165,600 pesos. So here we can now deduct this amount from the 9.4 million. So therefore, our final basis is 8,234,400 pesos. We will now multiply this with a rate based on the table that I have given to you in our previous lecture. Okay, so the applicable rate here is 60%. Why 60%? Because remember, the property was inherited 2.5 years ago. And if you're going to look at the table, as I have mentioned in our previous discussion, if the inheritance and the date of death is only within a year, that is 100%. Okay, but if the inheritance or gift and the date of death is more than 1 year but not more than 2 years, so the rate should be 80%. But if the date of inheritance or the time of transfer and the date of death is more than 2 years but not more than 3 years, that is 60%. In this case, that is 2.5 years. Hence 60%. Okay? Therefore, our vanishing deduction is 4,940,640 pesos. So we cannot deduct this this amount from our gross estate in our step 4. Actually, we are almost close to to finishing the solution of this problem. So we have here the computation of estate tax. So we have the gross estate of 25 million. We have ordinary deductions before the vanishing deduction, that was 3,100,000 in our step 2. And we have also vanishing deduction, that is 4,940,000 and 640 pesos. So overall, the sum of these two amounts will be the total ordinary deductions. So therefore, the net estate after deducting ordinary deductions is 959,360. So we have now deducted from the gross estate the ordinary deductions, okay, the lit, the losses, indebtedness, taxes, the transfer public use, in the vanishing deduction. We can now deduct also the special deduction, in which we have 3: the standard, the family home, and the RA 4917, in which in this case we have no RA 4917. We have no benefits received from RA 4917. So the special deductions we have here, standard deduction, which is 5 million, and of course the family home, that is 7 million. If you go back to the problem in step 1, you will notice that the same amount, 7 million, is deducted in this case. So therefore, the net taxable estate of Juan is 4,959,360. So since the decedent here is an unmarried single, therefore we cannot deduct the share of the spouse because Juan is single. This net taxable estate will now be multiplied by 6%, the estate tax rate, to get the estate tax due and payable of 297,561 pesos, 60 centavos. So that's it. That's how you compute the estate tax. After you computed the net taxable estate, you just multiply by 6%. Okay, so thank you so much for watching, and I hope you'd watch the other video that we have about the computation of estate tax for married decedents. Okay, if you love this video, give me a thumbs up. If you are new to this channel, please subscribe, click the bell so you'll be notified whenever I upload new videos. Thank you so much, and bye.